I'm Jamie Wilhelm, and I'm the lead portfolio manager for the all-cap focused equity and large-cap focused equity strategies at Fort Washington Investment Advisors. We believe we have a distinctive approach to active management that allows us the opportunity to achieve repeatable, long-term outperformance through an analytical advantage. First and foremost, we are value investors because value investing takes advantage of the one thing that will never be arbitraged away over time, and that is irrational human behavior. The key is, how do you know when you're getting to buy a business at a price that doesn't make sense? The way we define this is every business we buy in our portfolios is priced for one common element. That is, the equity price reflects that the business is going to earn very low returns on capital in the future. And once we know that, we have to answer one critical question. How hard is it for competition to get into the business? Or said another way, how are the barriers to entry of the business? Because if it is hard for competition to get into the business, that increases the odds the business will ultimately earn attractive returns on capital over time, and therefore the market is wrong in how the equity is priced. What is important is there are three ways we go about buying businesses priced for low returns on capital. First, sometimes we will buy businesses at replacement value, which is simply what would it cost to replicate the business from scratch today. Second, we will sometimes buy businesses at earnings power value, which is where you're only paying for the present value of cash flows from existing assets of a company. Last, we will sometimes pay for franchise value or future value creation, but we always try to limit the amount we're paying for the future. Whether we pay replacement value, earnings power value, or franchise value for a business depends on the level of the returns on capital and on the strength of the barriers to entry. The key point is the more we pay above replacement value, the higher the returns on capital and more formidable the barriers to entry need to be. What is really important to understand about our process is the way we value businesses allows us to marry the valuation conversation with the barrier to entry thinking. It is our secret sauce and something you cannot do with all other ways of valuing companies, such as PEs or EBITDA multiples, for example. With regard to barriers to entry, we have a common language as a team in order to create repeatability in the process. Specifically, we believe there are four types of barriers to entry. A supply barrier, which is basically a cost advantage, a demand barrier, which is customer captivity, economies of scale, and government barriers. The strength of any of these given barriers are evidenced by a company's market share stability, its pricing power, the level of the returns on capital of the business, and the return on capital stability of the business. Once we've assessed the barriers to entry for a company and use this analysis to inform our valuation work, we utilize a formal ranking system to determine position weights in the portfolios. Knowing when to sell a company is equally important as knowing when to buy. We are predominantly selling for two reasons. The company has reached our valuation target, or the capital is needed for a more attractive idea. With regard to the team implementing these beliefs, all of our team members that make up the 6-person management team have been selected based on very specific criteria to ensure philosophical continuity across the team. As I built the team, I knew every team member for many years before they joined our firm. Each member had deep sector experience in their respective area of coverage, and most importantly, each person had it in their DNA to believe in our way of valuing businesses prior to joining our firm. So in closing, besides our differentiated valuation framework and focus on barriers to entry, we like to run portfolios in a concentrated manner. Our portfolios tend to own approximately 25 to 40 businesses, as we believe our substitute is a passive strategy. So we need to focus in on the very best ideas in the marketplace and utilize a superior process in order to create value over a full market cycle.